Hi everyone, welcome again to this weekly show. We're going to make, as usual, a review of what's most relevant for this week, both fundamental and technical, and in the hope of making good trades, right guys? Anyway, let me start by sharing a bit the calendar for today, for this week, sorry. I know market has been, for the most, trading on sentiment, right? There's not much reaction to the news, to the headlines, but to price in oil prices and Chinese news. Those are the really market movers these days, and the ones that actually are affecting the currencies through market sentiment, right? Through investor sentiment. Sorry, it's hard to start speaking a different language when you have spent a week without doing so. Anyway, here we are. I believe that the most relevant news has been the lift of the international economic sanctions to Iran over the weekend. The country has been with a nuclear deal for long already. I believe that we start by June last year talking about this, but the sanctions were finally lifted last Sunday, right? It was confirmed on Sunday, and we had already the price oil sunk into flash lows below the $30 a barrel level, right? We have saw oil plummeting to 28, sorry, dollars a barrel, both Brent and US crude. Anyway, today it seems we are going to correct some of those movements, but I believe that the risk sentiment or the risk environment will prevail, right? So beware of that. As for the technical data, we had earlier in the week some positive inflation readings in Australia, which are helping the Aussie to recover some ground. But I do believe that we're going to see it in the charts, that these movements we're seeing are barely corrective, right? The Aussie is below 70 and will likely remain subdued. But these positive inflation figures are opening doors for another rate cut in case it's needed, because you know that what's preventing the rest of the economies of moving their rates is the fact that inflation is near deflationary levels, right? And this is a private gauge, right? This is not the official data, but anyway, it's a 2%, which is quite positive, and that's why it left doors open for a rate cut in Australia if needed, and therefore it's what will probably keep the Aussie subdued below the 70 level. Anyway, the most relevant data released earlier today was Chinese figures. Everything has missed expectations, and if you take a look at the numbers, they also came out below previous month readings, right? So in fact, it was pretty discouraging what we heard from China again. It's all news, right? China bad or negative data is all news these days. But anyway, it will, despite the market is moving against this risk aversion news today, right? The background is still quite negative and still favoring safe havens at Swiss, Shen, and gold. So beware of that. We had a UK data. This is pretty shocking, right? Because we have better than expected news in UK, although producer price index fell, remains in negative territory, of course, due to the decline in oil prices. And even despite this data was relatively good, the pound is failing to rally, right? So that is telling us how strong the bearish interest is in the pound, the bearish interest, speculative one, right? That's what I'm trying to say. I do believe that the rally is way overextended and the risk of an overcorrective movement is really high. But overall, the pound will continue to be weighed by the fears of a Brexit and the fact that despite we had a good bunch of data today, the readings have been quite negative for the past 3 or 4 months, right? So beware of that. Anyway, and for the upcoming days, I believe that most attention will center on Wednesday in US inflation and the Bank of Canada rate decision. There's speculation that the Bank of Canada can cut rates, although this is not reflected in the calendar right now. And of course, if the US inflation came out above expectation and shows some signs of improvements, that could make the market go running pricing a rate hike in the US as soon as March, maybe April. So beware of those two, right? And for Canada, the Bank of Canada, the market has generally a dovish stance ahead of the release, right? So beware of that. On Thursday, the ECB will gather most attention. I'm not expecting much from the European Central Bank, to be honest. The ECB has sort of delivered in December by extending quantitative easing by a good number of months. It was well below market expectations. It was a huge disappointment, right? But it's hard, really almost impossible to see the ECB acting 2 months in a row, right? They like to wait and see. Draghi wants to. So I'm not expecting actual action tomorrow. Okay, no changes in rates, no changes in quantitative easing, no changes in the policy, no changes in nothing. But that means that market will center attention in Draghi's wording and the statement following the release. And the general idea in the market is that it's going to be dovish, right? Because despite all the easing we have had for almost a year already, and the fact that they announced an extension, the economy is failing to pick up, the inflation is failing to pick up, and overall the situation is pretty dark in Europe, okay? So he has, Draghi will have to reckon that inflation remains subdued and that the economic recovery has not made any progress. And I'm not pretty sure how the market will react to this. It should be euro bearish, but we will discuss the euro in a few. Meaning, if the pair is the euro dollar is stuck, the euro is unable to find direction. It's well contained in range, and it's refusing to fall. Right? It's also refusing to advance. But I believe that from a technical perspective, it still holds a slightly bullish tone. We are going to discuss right now the levels to watch to revert that view. Anyway, those are for me the most relevant figures to be released tomorrow and the day afterwards. And of course, Friday will be also quite interesting with all the PMIs in Europe. Usually it had been good news coming from here, right? German, French, probably missing French one here, and European ones are expected relatively positive but below the previous one, which could put some pressure on the euro, right? And retail sales in the UK are expected to be a big miss. If they miss, or even worse than what we're expecting, that could see the pound plummeting towards 140. Beware of that because the slide did not over. And inflation in Canada could not be as much as relevant as the manufacturing PMI and the lead indicator in the US, both poised to determine how the week is going to end. Okay. Anyway, I would like to discuss better some technical points. So give me a second. I will try to share my charts if I can. Here we are. Okay, here we are. As I was saying, for the euro, the trading in here has been quite choppy. I will change. There we are to the daily chart, right? This is the latest ECB meeting rally. Okay, when the pair jumped from almost 400 pips, right after the huge disappointment coming from Draghi, right? So that huge rally had saw a corrective movement towards the 61.8% retracement early January, and then the pair has recovered, right? And here we are trapped in between the Fibonacci levels above the 38.2 but below this 23.6. And actually, if you take a look at the daily charts, 20 simple moving average is flat, indicators are going nowhere around their midline, so but we remain below the 100 and the 200. That's telling me that despite the lack of direction, only if we take that high around 1060, right? The upside will look much more constructive. Okay, and of course, if we break below that Fibonacci retracement, which is way far below current level, around 710, then we can confirm a bearish midterm rally, okay, towards maybe this lows or the 2015 lows, 40, 60, and 40 pips difference. Anyway, sorry, if you take a look at the 4-hour charts, right, the moving average, the 20, the 100, and the 200 ones, or the simple moving average, are all together in a 10 pips range, tight range, with the price moving back and forth, quite choppy around them. That's a real clear reflection of what's going on in here, which is nothing. Okay, nothing is going on. No, there's no clear direction, and there's no leading interest in here, not selling, not buying. So what I'm taking out from here is that we need at least to take this level of okay, with a 4-hour candle opening above it, to see maybe an advance towards 980, maybe 990, but I still see strong selling interest around this 110 level, right? The psychological figure, and that's what we need to take in the shorter term to see a spike to that 1060. On the other hand, around 840, 845, we have this support, and if we take it lower, right, the pair will probably extend down to 800. But take a look at this 4-hour charts, and many times the price has bounced from this level ever since December. Okay, with this, of course, this exception considering the low volumes we have at the beginning of the year, right? But 800, it remains as a buying level for me, and unless we have a huge news that can take the price below this level, I could attempt to buy on approaches to this area with tight stops below 780, which is the next Fibonacci support. Okay, if we take that, of course, then the decline could extend back to 710 or so, which is the lowest for this year. And when it comes to pound, that's what I was telling you earlier. We have been in a steady decline. It's nuts how far the pair has been going down, and technical indicators have attempted to correct in the daily chart several times, right? If you take a look, we have attempted to correct higher many times over this past 3 weeks, yet the result was a stronger selling interest surging on those upward corrective movements and fresh lows. The pair reached so far 42.35, which is low set earlier today. We have May 2010 low around 42.20, which is for me a major support, right? If we take that, then the rally will probably extend towards 140, as I was saying earlier. Anyway, in the 4-hour charts, if you take a look at this chart, it's pretty interesting how this 20 simple moving average has been leading the way lower, right? As any approach to the moving average has ended with a fresh low and attracting selling interest. And here we are again today with a good, relatively good key data. The pair attempt to spike above it, but it's failing to go higher, right? And it will probably resume its slide despite improved market sentiment. This is telling me that there's still no end or still no bottom confirming in here. Okay, and we have former lows in the 43.50 region, so I would like to see the pair closing the day above this level and open with a positive tone during the upcoming Asian session to change my view to a more bullish constructive one. So at this point, I believe that selling against this 43.50 area should be a bit more interesting than attempting to buy and to confirm the bottom has been reached. Okay. Anyway, as I was saying, the OC is recovering more ground, okay, this week, but still failing around 70, still unable to reach that psychological mark. Okay. And of course, today, both the OC and the CAD are rallying on relief, particularly because oil has bounced back above $31 a barrel. Pretty interesting bounce, and not much of a catalyst beyond it, but there we are. I believe it's part corrective, part profit taking ahead of the ECV, right? The market will probably try to reposition itself afterwards. And so far, we're taking profits of high speculative selling positions in crude. Beware of that. Anyway, the recovery in commodities is helping DOC to bounce, and this rally can extend up to 70 today. Yet we need to confirm a clear break of that level, which I'm not yet seeing because I do believe that's still bearish, to advance up to 71.40, 71.50, which is the next strong resistance level for this week. On the other hand, if a pair gives back some ground again below the 69 level, I would expect a retest of this low 68.25 or so, and even fresh lows towards 67.10. That's the main bearish target I have in here at this point. Anyway, most of the technical readings are telling me that the bearish momentum persists, and that we are seeing right now it's a temporal corrective movement. Take a look at the indicators are barely crossing their midlines with the current candle, and yet not confirming that further gains are likely, right? Yeah, that's my view. Related to OC, but not so correlative to these days, it's gold, right? The improved market sentiment today is pushing the commodity back lower. I do see a bearish case building up in here despite this choppy price action. Oh, take a look at that. Anyway, I do still believe that the pair, I still see the pair, the commodity, falling hard, right? And the line in the sand would be that weekly low around 71.40. I would expect it to reach this level in the next couple of days, particularly if risk-averse trading continues easing, okay? But for the most, I do believe that gold has only one way, and it's down. And when we have these risk aversion rallies are just setting opportunity. I really I'd say that a couple of times before, but I still see it in that way. And I do believe that higher levels and approaches to maybe those Fibonacci regions are the levels to watch to confirm the sell, right? Okay, most of the gold weakness to these days are coming from this constant recovery in crude. We are okay, higher and higher weekly highs, 31 above last week was. Seems we are correcting, as I said. I don't know that there's a lot of way to go in here to even talk about a bottom. This would be my line in the sand. This says 33.50, which is the 20 simple moving average in the daily chart. I could see the commodity correcting up to that level, right? And maybe then resuming its decline or even earlier. I'm not daring yet to say that this is bottom, okay? I'm not yet, but as I was saying, I believe that this upward corrective movement we are seeing today is more related to some profit taking than anything else, due to extreme oversold readings and conditions in here. Anyway, the dollar Japanese yen is advancing, okay, adding some ground, but if you take a look, it's still below Friday's opening. It's way below the end. So I don't see much of an upward potential in the longer term. Shorter term, yeah, we have some, but very limited. Take a look at the 1 hour charts, shorter time, which just overcame the 1 and the 200 simple moving average, but they are both heading lower, and the shorter is below the larger, right? So this need to change to sustain the ongoing rally. And in the 1 hour chart, the pair is slightly over both. So maybe we can go up to this 18, 20, 40 region, and there we will talk about if the pair will be able to run farther or not. Anyway, for me, the line in the sand comes around 1935, which has been a former very strong support resistance in November and early December. And if a pair manages to regain that level, then the upside seems more likely. But overall, I believe that the Yen will continue to advance, and we can go down to 60. Take a look at the daily, right? We did not test this level. We stalled 50 pips shorts of it in the latest decline. So I would like to see a test of it. Anyway, we can consider this a probable double floor. but the neckline in that case would be 2370. So we are way far away from confirming the figure and talking of bullish run. Of course, if we regain that level, that should signal 700 pips rally. So, but for that, we need to break this high. Anyway, slightly positive in the short term, still bearish in the longer one. If we lost 1740 region, I could expect a decline towards 16 in a year, okay? And the Canadian dollar, I'm not a big fan of the Canadian dollar, but of course it's highly correlated with whatever's going on in oil, with the Canadian dollar appreciating when the crude does. So at this point, with oil correcting higher, so is doing the Canadian dollar. Is higher against the greenback. That's why the pair is falling. The technical picture seems poised to continue climbing because take a look, the momentum crossed the 100 level towards downside. Current candle open below its 20 simple moving average and even complete a pullback to it. But we're holding about this Friday's low, and even those highs seems a much stronger level. 44 region, right, 40 pips away from the current level. If we take that level, then there are a good chance that we'll see further declines today, or at least during the upcoming sessions, right? Euro is falling alongside with Aussie. Now, it's risk-related trading, guys, and it's pretty messy, pretty dark. Beware of whatever stocks are doing, because if stocks continue rising, that will, and alongside with oil, of course, those three are the ones leading the way. Okay, because if those continue rising, that would mean the euro and yen will probably continue falling. Okay, and the CAD will rise, and so the Aussie, right? Sorry, a bit messy. Anyway, yeah, I believe that's it for today. Pretty much, we have covered the most interesting things for the upcoming days. So I hope you have a great week and great trades ahead, and see you back next Tuesday. Okay, thank you. Bye bye.